Welcome to The Deep Dive, where we really try to unpack the stories behind the headlines, get you those essential nuggets of knowledge.
Yeah, hopefully cutting through some of the noise.
Exactly.
Yeah.
And today, we're diving into something. Well, it's fascinating, but frankly, it's quite alarming. A story from the Indian financial markets. It involves a major global trading firm, Jane Street, and just a staggering sum of money. We're talking a whopping Rs 735 crore in profit.
Allegedly made.
Allegedly made, exactly, in just a single day.
That's right. And it's not just about those eye-popping figures, though they certainly grab your attention.
Barely do.
It's more about understanding how such a, sophisticated operation could allegedly manipulate one of the world's largest derivatives markets.
Right.
And what that means for basically every investor out there, big or small, anyone who participates in or just relies on the integrity of those markets.
Yeah, the trust factor.
Yeah.
So our mission today is to sort of pull back the curtain on who Jane Street actually is, what their alleged activities were in India, how the market regulator, Sebi, caught on to this really intricate scheme, and maybe most importantly, what this whole episode reveals about, well, the sanctity, the future of India's booming financial landscape.
It's a big one.
It is. It's a story of, incredible financial gains, but also alleged deception and a direct impact on the fairness of the market. Potentially for you, the listener. Okay, let's unpack this.
Let's do it.
So let's start with Jane Street itself. This isn't, some small-time player operating on the fringes. They're consistently called a U.S. trading powerhouse. Can you give us a sense of their actual scale? What are they known for globally?
Yeah, absolutely. And what's really fascinating about Jane Street is just their evolution and their sheer scale now.
Right.
The Jane Street Group, LLC, it started pretty modestly, actually, back in 2000. Just a handful of people in a small New York office.
Okay, so humble beginnings.
Very much so. But fast forward to today, they've completely transformed into a financial behemoth is probably the right word. Over 3,000 employees.
3,000, wow.
Yeah, spread across 5 global offices.
Yeah.
You've got New York, London, Amsterdam, Hong Kong, and Singapore. They're active everywhere.
So truly global reach.
Absolutely. They're trading a huge, diverse array of asset classes. Equities, bonds, ETFs, and really significantly for our discussion today, derivatives.
Ah.
Okay.
The derivatives piece.
Exactly. And their operations span more than 200 trading venues.
200 venues.
In 45 countries. So yeah, they're a truly global entity deeply embedded in the world's financial plumbing.
Okay. And how do they build that reputation? What's their sort of secret sauce, if you will?
Well, they've built their reputation and, frankly, their immense success primarily on their expertise in high-frequency trading, HFT strategies.
High-frequency trading, okay.
Yeah, and it's not just about speed, though obviously milliseconds matter hugely in that game.
Sure.
It's more about deploying these incredibly sophisticated algorithms. Think complex computer programs that can analyze just colossal amounts of market data in real time.
Right. Sifting through everything.
Instantly. Identifying tiny price discrepancies or maybe arbitrage opportunities across different exchanges, and then executing trades faster than any human could possibly react.
Faster than thought, almost.
Pretty much. And they're often lauded, for being premier market makers.
Market makers, what does that involve?
Essentially, they provide liquidity to markets. They're constantly offering to both buy and sell securities. This allows buyers and sellers to connect more easily, more seamlessly, efficiently.
So they help the market function smoothly, normally.
Generally, yes.
Yep.
That role is usually seen as beneficial for market health, which, makes their alleged pivot to manipulative strategies in India all the more, striking and concerning.
Right. It seems contradictory to that market-making role. And you mentioned they're a proprietary trading firm. For our listener, what exactly does that mean? It sounds like they just trade for themselves, but I imagine there's more to it.
Yeah, that's a really crucial distinction. Think of it this way. You have firms like hedge funds or mutual funds, right? They manage other people's money.
Right, client money.
Exactly. A proprietary trading firm, or prop shop, as they're often called, trades exclusively with its own capital, its own money.
Okay.
So imagine maybe a professional poker player sitting at a really high-stakes table, playing solely with their own massive bankroll, rather than managing a pool of bets for a group of clients.
Got it. So they're not answering to outside investors.
Precisely. They're not beholden to external clients or specific investment mandates or, doing quarterly reporting to outside investors about performance.
That must give them a lot of freedom.
Immense freedom
Yeah.
and flexibility. They can execute incredibly complex, really rapid-fire, often high-risk strategies without needing to explain every move or stick to specific risk profiles that clients might demand.
But the flip side is they bear all the risk themselves.
Exactly. They own the wins, but they also own the losses entirely. And in this specific case, according to Sebi's allegations, they leveraged this self-funded, self-directed structure to, well, allegedly reap massive rewards.
Right.
So that distinction is vital because it highlights this direct, unmitigated pursuit of profit for the firm itself. It's not constrained by external client obligations, which, sometimes that can lead to more aggressive strategies.
The incentives are purely internal.
Yep.
Now let's talk about the numbers, because they are truly mind-boggling. This is a key part of what brought this whole thing to light.
Right.
Sebi's order revealed Jane Street allegedly made, get this, RS a 735 crore profit in a single trading session on January 17th, 2024.
Just one day. It's incredible.
And that's just one day. Their total alleged profits across various Indian market segments, this is from January 2023 to March 2025, amounted to a staggering RS 36,502.12 crore.
36,000 crore.
Yeah, and Sebi noted a significant portion, specifically RS 32,681 crore, was reportedly booked by their foreign portfolio investor entities, their FPIs,
Right.
and then repatriated abroad, sent out of India. That is just an astonishing amount of money.
Right.
Indeed, the figures are, well, they're eye-popping, as you said. But it's crucial to understand that the core accusation from Sebi isn't just about them earning a lot of money.
Right. Making profits isn't illegal in itself.
Exactly. Not if it's earned fairly. The allegation, the real crux of it, is how they made it. Sebi alleges they inflated prices before selling aggressively, profiting from options while retail investors were misled.
Inflated prices misled investors. Okay.
So this isn't being presented as just smart trading or, leveraging legitimate market opportunities or even just being faster than everyone else in a fair race.
No.
Instead, it points towards a highly calculated, systematic strategy of market manipulation.
Okay. Manipulation. That's the key word here.
Yes, this alleged manipulation, Sebi says, was explicitly designed to distort the natural market dynamics purely for their own benefit, creating an artificial environment rather than just participating within the existing natural market movements.
So shaping the market, not just reacting to it.
Exactly. And that accusation fundamentally questions the fairness and the integrity of the market, especially when you consider that, less informed or maybe less sophisticated retail investors are often on the other side of these highly intricate, allegedly manipulative maneuvers.
Right. They're trading against this.
Yeah. It suggests a deliberate act to influence and exploit rather than simply trade based on fundamentals or normal flow.
So this wasn't just them being brilliant traders or having superior tech necessarily. It was allegedly them actively shaping, maybe even engineering, the market to their advantage.
That's the core of the allegation, yes.
If this was market shaping,
Mhm.
how did Jane Street allegedly manage to orchestrate something so intricate? It sounds incredibly complex to pull off, especially in a big market like India's.
Oh, it was incredibly intricate, according to the Sebi order. The strategy appears highly elaborate, multi-layered. It indicates, a deep understanding of market mechanics and, crucially, how to potentially exploit perceived vulnerabilities or loopholes. Sebi's investigation really did pull back the curtain on this alleged scheme. And they focused particularly on that astonishing day, January 17th, 2024, when they purportedly made that massive single-day profit.
Right, the 735 crore day, let's zoom in on that. The Bank Nifty Index, that's a key banking index in India, it actually started that day significantly lower.
It did.
And media reports at the time, I remember seeing them, often suggested it was because HDFC Bank had disappointing quarterly results.
That was the common narrative, yes. HDFC Bank is a major component of that index.
Exactly. But Sebi's investigation found something much more complex, a dual-phase approach at play, suggesting that initial market dip was maybe just the backdrop for a calculated operation.
That's what Sebi alleges, yes. It wasn't just about reacting to the HDFC news. They identified two distinct phases, which they labeled Patch 1 and Patch 2.
Okay. Walk us through Patch 1 of this alleged scheme. What happened first?
All right. So during Patch I, Sebi alleges Jane Street embarked on just massive purchases, buying huge amounts of the stocks that make up the Bank Nifty Index and also Bank Nifty futures contracts.
Buying aggressively. How much are we talking?
The value was enormous, Rs 4,370 crore.
4,000 crore just in buying.
In that initial phase, yes. And to give you a sense of scale, Sebi specifically noted this was considerable relative to typical market trading volumes for that time. It wasn't normal market activity.
Okay, so a huge buying spree. What was the effect?
Well, the effect of these massive, aggressive acquisitions was predictable. It caused prices to rise, both the individual stock prices and the index futures. It created this artificial sense of a market recovery.
An illusion of recovery.
Exactly. They were essentially creating an illusion of genuine demand, of positive market sentiment turning around, even though the initial reason for the drop, like the HDFC results, hadn't really changed fundamentally.
Can you give us a layman's example? Like, how would that work in a simpler setting?
Sure, let's use a simple analogy. Imagine you're at a bustling farmer's market, right? Lots of people buying fruits and vegetables.
Okay.
Suddenly, a very wealthy buyer arrives. This buyer isn't just looking for a few apples. They start aggressively purchasing every single basket of a specific, popular type of apple. Let's say golden delicious apples.
Buying up all the golden delicious.
All of them, very quickly. This huge, sudden influx of demand immediately makes the price of those golden delicious apples skyrocket.
Makes sense. Supply and demand.
Right. Now, other shoppers, observing these rapidly rising prices for Golden Delicious, might mistakenly think, wow, Golden Delicious must be incredibly popular today. Or maybe there's some amazing new health benefit discovered. The market for these apples is really picking up. Maybe I should buy some too before they go even higher.
Yeah. Fear of missing out. FOMO.
Oh, exactly. Even if the underlying reason for maybe a slow start to the market that day for other goods hasn't changed at all. Jane Street, Sebi alleges, created this exact kind of false impression of a recovering market, drawing in other participants who might have otherwise been cautious or even bearish, betting on prices falling.
Okay, so they're pushing prices up with this massive buying in patch one. But simultaneously, while they were doing this, Sebi says they were building up what they call bearish positions in the Bank Nifty Index options.
That's the crucial other side of the coin.
And the amount was colossal. Rs 32,114.96 crores in these bearish option positions. Can you explain what bearish positions in options means, simply?
Of course. So options, in simple terms, are financial contracts. They give you the right, but importantly not the obligation, to buy or sell an underlying asset, in this case the Bank Nifty Index, at a specific price called the strike price by a certain date, the expiry date.
Right. The right, but not the obligation.
Exactly. Now, when we talk about bearish positions, it means Jane Street was essentially betting that the index, the Bank Nifty, would fall in value. They were positioning themselves to profit if the market went down.
Okay, betting on a fall. How do they do that with options?
They allegedly achieved this by strategically buying cheap put options and selling expensive call options. Let's break that down.
Please.
A put option gains value when the price of the underlying asset, the Bank Nifty, falls below the strike price. So by buying puts, they were directly positioned to profit from a decline.
Okay, buying puts, bet on a fall.
Right. Conversely, a call option gains value when the price rises above the strike price. By selling calls, especially expensive ones, meaning that the market thought there was a decent chance of a rise, they were essentially betting against a rise.
Selling calls, bet against a rise.
Precisely. They collect the premium, the price of the option, up front. If the index stays flat or falls, those calls they sold expire worthless, and they keep the premium as profit.
Okay, so they were setting themselves up for massive gains if the market went down. Even as they were temporarily pushing it up with their patch one stock and futures buying.
Exactly. It's like placing a massive bet on your favorite football team to lose the game while you're momentarily cheering for them loudly in the first quarter just to confuse everyone else.
That's quite the gambit. Pushing prices up with one hand, betting on them to fall with the other. So what happened next? What was patch two once they'd seemingly created this artificial upturn and taken these huge bearish positions?
Right. So in the subsequent phase, patch two, Sebi alleges Jane Street then disposed of almost all its long-term holdings, which here refers to the stocks and futures they had just aggressively acquired in patch one.
They sold everything they just bought.
Pretty much, yes.
Yeah.
And these sales were not gradual or careful. The order describes them as aggressive in a manner that pushes down prices in the component stocks and hence the index.
So after creating the artificial rise, they intentionally pushed prices down by dumping everything.
That's the allegation. offloading their positions en masse, creating huge selling pressure. Now, interestingly, Sebi notes they actually booked losses on these intraday cash and futures market trades, the buying high in patch 1 and selling lower in patch 2.
They lost money on the stock trades.
On that specific part, yes. But these losses weren't accidental, according to Sebi. They were almost like a calculated cost of doing business.
The cost of doing business?
Yeah, a necessary expense, if you will, to execute the broader, far more profitable options scheme. That small loss on the initial stock and futures purchases was, allegedly, a deliberate investment in making their much larger bearish options bets pay off spectacularly.
Okay, let's go back to the Apple market analogy. How does patch 2 fit in there?
Right. So after creating that artificial buzz around golden delicious apples in patch 1, and after placing their hidden bet that Apple prices would inevitably fall, the rich buyer, suddenly, in patch 2, dumps all those golden delicious apples they had bought earlier back onto the market. Just floods the market with an excess supply.
Creates a glut.
Exactly. This causes golden delicious apple prices to crash dramatically. Now, the rich buyer might take a small tactical loss on the apples themselves. They bought them high, sold them low.
Right.
But their real massive profit comes from the bet they made earlier, the put options analogy. The one that paid off handsomely when Apple prices plummeted due to their aggressive selling.
I see. So it's a two-step process.
Yeah.
Allegedly manipulate demand up, then allegedly manipulate supply down, all while holding a huge bet on the outcome you engineered.
That's precisely the alleged mechanism. Create the illusion, then create the crash, and profit from the whole engineered swing.
And the key here, the absolute linchpin, is that the profits from their index options, those puts they bought and calls they sold, significantly outweighed their losses in the cash and futures market, correct?
Precisely. That's where the alleged Rs 735 crore profit in just that one day came from.
Right.
When the Bank Nifty Index declined sharply from its artificially created morning peak, exactly as Jane Street had allegedly engineered it to do those put options they bought in patch, it became incredibly valuable.
Because the market fell hard.
Exactly. And simultaneously, the call options they had sold earlier, which would only have been profitable for the buyers if the market had kept rising, became worthless as the market tanked.
So Jane Street kept the premium from selling those calls.
They did. And the combination, massive gains on the puts they bought, plus keeping the premium on the calls they sold, created enormous profits in their options positions. Profits that more than compensated for their tactical, calculated losses in the cash and futures segments.
So it really wasn't just a series of unrelated trades or even just super fast HFT reacting to news.
Not according to Sebi. They paint a picture of a deeply coordinated two-phase strategy, where the losses in one segment were a deliberate, calculated investment, a cost for securing disproportionately larger profits in another segment.
It sounds like a chess game, really. Sacrificing a pawn to capture the queen.
That's a very good analogy. Every loss was allegedly a calculated sacrifice for a much larger, predetermined win. It fits the description of a classic, sophisticated manipulation scheme designed to create a specific market outcome, rather than just participate in market discovery.
What's truly fascinating, and maybe more concerning, is that this kind of alleged activity wasn't a one-off thing, not just that one day in January.
No, not at all.
Sebi's investigation actually covered 18 trading days in total, and Jane Street allegedly employed these identical intraday index manipulation tactics, the patch 1, patch 2 thing, on 15 of those days.
15 out of 18. It suggests a repeatable playbook.
Absolutely. And for the remaining 3 days they looked at, Sebi says they used another strategy, something called extended marking the close. What exactly is that? And why is the close, the end of the trading session, so significant?
Right. Marking the close is a tactic that's unfortunately been around for a long time in trading circles. It's generally considered manipulative, and Jane Street allegedly used an extended version of it.
Okay, what does it involve?
It basically involves placing exceptionally large and usually very aggressive buy or sell orders very, very close to the end of the trading session, like in the final minutes or even seconds.
Right near the closing bell.
Exactly. And the deliberate intention behind these large late orders isn't necessarily about genuine buying or selling interest at that price. It's specifically to artificially move the stock or index's official closing price.
Why is that closing price so important?
Because that closing price is absolutely critical in financial markets. especially on derivatives expiry days.
Ah, expiry days again.
Yes,
Right.
because that final closing price directly determines the settlement value for billions of dollars worth of futures and options contracts. Even a tiny, seemingly small shift in that final closing price, maybe just a few points on an index or a few cents on a stock if you have massive positions like Jane Street allegedly did, that tiny shift can translate into millions or even potentially billions in profits or losses for positions tied to that final price.
So it's all about influencing that very last snapshot of the market for settlement.
Precisely. It's manipulating the final score, essentially.
Can you give us another analogy for marking the close?
Sure. Let's think about, imagine a student who needs to achieve a very high average grade for a semester-long class project. And let's say their performance throughout the semester has been, well, inconsistent. Maybe they struggled on some earlier assignments.
Okay, mixed results.
Right. But then imagine somehow this student gets to design the grading criteria for the final, most heavily weighted part of the project themselves, just before grades are officially due.
Rigging the final exam, basically.
Essentially, yes. They ensure they ace those last, most important assignments according to criteria they set, which allows them to artificially inflate their overall final score for the semester, even if their actual consistent performance throughout the term wasn't really top tier.
So it's not about genuine performance, it's about manipulating the final calculation.
Exactly. Jane Street allegedly did this with market prices, particularly targeting expiry days, to affect the final settlement value of their massive options and futures contracts, ensuring they profited from an artificially influenced closing price rather than a price determined by natural end-of-day market forces.
Okay, that makes sense. Now, there's another layer to this alleged strategy. It involves Jane Street's Indian arm, their local entity, JSI Investments Private Limited.
Yes, the local connection.
It seems they might have found a kind of workaround for certain Indian regulations using this entity. How did JSI Investments fit into the grand scheme?
Right. This is where the alleged sophistication really comes into play, particularly when it comes to navigating the regulatory landscape.
Okay.
Under Indian regulations, foreign portfolio investors, FPIs, like Jane Street's main global entities, are typically not allowed to engage in certain types of cash market trades, specifically intraday trading, where you buy and sell the same stock within the same day.
Why is that restriction there?
It's generally in place to prevent excessive speculation or potential market manipulation by foreign entities that might not be fully subject to the same level of local oversight or capital requirements as domestic players, a kind of safeguard.
Got it. So FPIs can't do intraday trades. What did Jane Street allegedly do?
What Sebi's investigation found was a very interesting dichotomy. While Jane Street's primary FPI entities, the ones based overseas, were allegedly making these huge profits in the derivatives market from these manipulation strategies.
Options and futures.
Exactly. Their local Indian entity, JSI Investments Private Limited, was consistently booking losses in the cash market, specifically through intraday trades.
The Indian entity was losing money while the foreign ones were making billions.
Consistently, yes, according to Sebi's findings. And Sebi alleges this wasn't accidental. The Indian entity's activity essentially served as a kind of, well, camouflage or perhaps a workaround.
Camouflage.
Yeah. It made it appear as though Jane Street, as a whole group, was complying with Indian regulations. Look, see, we have a local entity doing some normal trading here, even if those trades systematically lost money.
While the real action was happening elsewhere.
Exactly. This allegedly allowed their core, highly lucrative and allegedly manipulative strategies to continue unabated in the more profitable derivative segment, which was largely driven by the foreign FPI entities.
That sounds very cleverly structured, if true.
It's a very clever, albeit highly problematic, according to Sebi, way to potentially navigate and maybe circumvent regulatory restrictions, creating an illusion of compliance while allegedly pursuing illicit gains elsewhere in a different part of the corporate structure and a different market segment.
So the coordination was key.
Absolutely. The trades in the index futures, the stock-level trades, allegedly executed across both their foreign FPIs and their Indian arm, worked in concert. All designed, Sebi claims, to support and steer the Nifty and Bank Nifty indices in the direction they needed for their options to pay off.
It really wasn't about reacting to market moves. It was about creating them, allegedly.
That's the allegation. And the fact that this activity was apparently concentrated around those critical expiry days when the financial stakes are highest and even small price shifts have exponential impacts on options values, that further underscores the alleged manipulative intent in Sebi's view.
So a truly integrated, multifaceted operation designed, allegedly, to exploit the very structure of the market for extreme profit.
That's the picture Sebi paints in its order, yes.
This really raises an important question. Given the scale, the coordination, the sheer brazenness of these alleged activities,
Hmm.
were there any red flags, any warnings before Sebi finally dropped the hammer with this definitive action? It seems like such a massive operation wouldn't go completely unnoticed for long, even for a sophisticated firm.
You're absolutely right to ask that. And yes, there were indeed early warning signs. It wasn't completely out of the blue.
Okay, like what?
The National Stock Exchange, the NSE, which is India's largest stock exchange and operates under SEBI's overall direction, had actually issued a clear and formal warning directly to Jane Street Group.
A formal warning from the NSE itself. When was this?
This was as early as February 2025, so several months before SEBI's final order in July.
And what did the warning say? Was it specific?
It wasn't a subtle hint, no. The notice was apparently very specific. It advised Jane Street to avoid high-risk activity, particularly in index options, and more broadly, to refrain from any trading behavior that could even suggest manipulation.
So the exchange was definitely seeing concerning patterns.
It certainly seemed so. They communicated directly with the firm about their concerns. The regulator and the exchange were aware of potential issues.
Okay, so Jane Street gets this formal warning from the NSE. How did they respond? Did they acknowledge it? Did they change their approach? Or
Well, in response, Jane Street Group formally assured the NSE in writing, it seems, in that same month, February 2025. They gave an unwavering commitment to fully comply with all applicable regulations.
Okay, so they pledged compliance.
Yes. It appeared, at least on the surface, that they understood the caution and promised to adhere to the rules. Standard corporate response, perhaps.
Right.
But the SEBI order reveals a really troubling pattern that seems to directly contradict that assurance.
How so?
According to the order, in May 2025, just 3 months after giving that formal pledge to the NSE, the group allegedly again executed manipulative, extended marking the close strategies.
After promising not to.
That's what the order alleges. They apparently persisted with similar trading activities, explicitly disregarding both the exchange's cautionary communication and their own pledges.
Wow. That suggests, well, a blatant disregard for the warning and their own commitment.
That's certainly how SEBI portrays it. And for the regulator, that kind of behavior would significantly strengthen the case about their alleged manipulative intent. It wouldn't look like an accidental slip-up or a misunderstanding. It would look like a continued, deliberate pattern of behavior despite being warned.
So they received a direct warning, promised to comply, and then allegedly just carried on with the same behavior. That's quite a significant detail. It really points to a perceived defiance.
That's exactly what the SEBI order indicates, yes. Portraying a situation where Jane Street, despite being formally cautioned by one of India's largest exchanges, allegedly chose to persist with these strategies.
Were there other signs? You mentioned whispers earlier.
Yes. It's also worth noting that apparently whispers and concerns about Jane Street's unchecked, maybe overly aggressive trading strategies had been circulating in certain market circles since early 2024, long before that formal NSE warning in Feb 25.
So it wasn't entirely hidden from experienced market watchers.
It suggests not. Some market experts, looking back now with hindsight, of course, even believe the regulator perhaps should have stepped in more forcefully, sooner, rather than waiting for the NSE to issue a caution first.
Hindsight is 20/20, I guess.
Always. But it does highlight this ongoing challenge for regulators everywhere. How do you identify and act swiftly enough on complex, high-frequency manipulation, especially when it involves these highly sophisticated global firms that operate at lightning speed across multiple borders and asset classes? It's tough.
Absolutely. So with the NSE concluding its investigation, the warnings allegedly ignored, the evidence mounting, Sebi finally took definitive action. July 5th, 2025. What were the immediate stringent consequences for Jane Street and its associated entities? This wasn't just a slap on the wrist, was it?
Oh, absolutely not. Sebi issued extremely stringent orders. They clearly wanted to send a very strong, unequivocal message to the market.
What did they do specifically?
First, they prohibited Jane Street and 4 related entities from participating in any Indian securities trading, effectively banning them from accessing the market altogether.
A complete ban.
Yes. Second, they directed banks to restrict withdrawals from Jane Street's accounts in India, essentially freezing their ability to move funds freely within the country.
Locking down the money.
Trying to, yes. And third, crucially, Sebi initiated proceedings to seize or disgorge Rs 4,843.57 crore in purported unlawful gains.
Nearly 5,000 crore. That's a huge chunk of the alleged profits they made.
It is. It's a very significant portion. This was not a minor penalty. It was a comprehensive and strong message from the regulator, all outlined in a very detailed 105-page order.
100 pages. They clearly did their homework.
It seems so. It emphasized the seriousness of the alleged violations and the regulator's firm intent to recover what they deemed ill-gotten gains. And obviously, an action like that sends ripples through the entire Indian financial market and, frankly, the global trading community as well.
Absolutely. Now, this whole investigation, this whole saga has shed new and, frankly, deeply concerning light on something Sebi had already highlighted independently before this case blew up, which is that statistic that 93% of retail options traders are already losing money in the Indian market. 9 out of 10 lose. How does Jane Street's alleged activity tie into that really disheartening statistic? What does it mean for you, the individual investor listening to this?
Yeah, that 93% figure was already stark. But the findings in the Jane Street case now provide, well, Sebi calls it additional context. I'd say it's a very dark context for those widespread retail investor losses.
How so?
Sebi explicitly concluded in their order that such losses, the losses experienced by retail traders, are reflective of the deep damage that the group have inflicted through their illegal activities.
So they're drawing a direct link.
They're suggesting a direct causal link, yes, between Jane Street's alleged manipulation and the financial harm experienced by these individual, often less sophisticated investors.
That's a powerful statement from the regulator.
It is. Think about it. When a large, extremely fast, algorithmic firm is allegedly inflating prices artificially and then aggressively selling into that inflated price to profit from options bets, it creates an incredibly unfair playing field.
Completely tilted.
Exactly. Retail investors, who are often reacting to market movements they perceive as genuine, driven by fundamental news, or normal supply and demand they could be unwittingly buying into artificially inflated prices created by Patch 1, or selling into the panic of the artificial crash created by Patch 2.
They're trading based on a mirage.
Essentially, yes. A mirage deliberately created by someone else if the allegations are true. This dramatically increases their risk and their likelihood of losses. It makes that 93% statistic even more concerning.
It really does.
It tells you that even if you're trying your best to make sound decisions based on the information you have, you could be operating in a manipulated environment without even knowing it.
That's deeply unsettling for anyone trying to participate fairly in the market. So moving beyond the immediate financial impact on Jane Street, and the direct harm alleged to retail traders. What does this all mean more broadly? For you, the individual investor's trust, and for the overall health and integrity of the Indian financial markets going forward?
The implications are really far-reaching. This kind of alleged manipulation, if proven true in the courts or appeals process, does far more than just distort prices in the short term. It fundamentally harms retail investors who trade with trust and limited capital.
It hits the little guy the hardest.
Often, yes. It directly impacts their ability to make fair returns, maybe build savings for retirement, or achieve other financial goals. But perhaps even more significantly, the damage isn't just financial.
What else?
As Gaurav Goel from a firm called Finocrat Technologies articulated quite well, it erodes faith in the system.
Trust. Back to that word again.
It's the bedrock. Trust is the absolute bedrock of any functioning financial market. If investors, particularly individual investors, start to believe the game is rigged, or that large, powerful players can manipulate prices with impunity.
They'll just walk away.
Exactly. They'll eventually disengage, or they'll demand much higher risk premiums, making capital more expensive for everyone. Incidents like this shake that foundation. They make it harder for honest participants, both big and small, to thrive, and potentially harder for new, legitimate capital to flow into the market confidently.
It really sends a chilling message, doesn't it? That no matter how much research you do as a small investor, you could still be at a huge disadvantage due to orchestrated, hidden market movements.
It can definitely feel that way. And it must be incredibly disheartening for everyday investors just trying to make sound decisions based on fundamentals or sensible strategies, only to suspect the playing field might be artificially tilted against them. It feels like a betrayal of the market's supposed fairness and transparency.
Yeah, a betrayal. And this case has undeniably exposed, or at least highlighted, potential regulatory blind spots within the Indian financial system, wouldn't you say?
Oh, absolutely. It has triggered an urgent and, frankly, absolutely necessary debate over whether the regulator, Sebi, can effectively keep pace. keep pace with the sheer speed, the complexity, the scale of modern derivatives trading.
Especially with HFT and algorithms involved.
Exactly, which often involves these high-frequency algorithmic strategies, intricate cross-border operations, multiple layers of entities. It's a whole different ballgame than traditional stock picking.
So it raises a critical question. What specific gaps have maybe been identified by experts in light of this? And what concrete reforms are now being called for to address these vulnerabilities and try to prevent future such alleged manipulations?
Well, several key areas have come up. One major point experts are making is the need for systems that can track both stock and options markets together in real time.
Integrated surveillance.
Yes, rather than looking at them in isolation, in separate silos. Because, as we saw with Jane Street's alleged scheme, the manipulation involved highly coordinated actions across different market segments. The stocks, the futures, the options.
Right, you need to see the whole picture to spot the pattern. Can you elaborate on the challenges of actually doing that? It sounds technologically demanding.
It's a massive data integration and technological challenge, not just for India, but for regulators globally. Traditionally, regulatory bodies often have had somewhat siloed surveillance systems for different asset classes. One team looking at equities, another at options, maybe another at futures.
Personalization.
Yeah. But to catch a sophisticated multi-asset class scheme like the one Jane Street is accused of, you need to do more than just collect the data. You need to integrate real-time trading data from multiple exchanges, multiple asset types.
Billions of data points.
Trillions, probably. And then you need to build algorithms, likely using AI and machine learning, capable of detecting these subtle patterns of potentially suspicious coordinated activity across those different silos.
It's like finding a needle in a haystack, but the haystack is moving at the speed of light.
That's a good way to put it. It's like trying to spot a coordinated flash mob across several city blocks when you only have separate cameras watching one block at a time, and the mob is moving incredibly fast. The sheer volume and blistering speed of HFT make this exponentially harder. It requires cutting-edge tech, which many regulatory bodies are still actively developing and implementing.
Okay, so integrated surveillance is one big area for reform. What else are people calling for?
Beyond the tech, experts are advocating for tighter expiry day limits.
Stricter rules around expiry.
Yes, implementing maybe stricter controls, perhaps wider circuit breakers, or more intense scrutiny specifically on trading activity during those critical settlement periods at the end of expiry days. Because, as we discussed, that's precisely when tactics like marking the close are most potent and impactful.
Makes sense. Close the window of opportunity for manipulation.
Kind of, yeah. There's also a significant call for more transparency in foreign portfolio investor FPI structures.
And getting behind the corporate veil.
Exactly. This isn't just about knowing the name of the FPI registered. It's about understanding the beneficial ownership, especially in these complex, often nested corporate structures that global firms use.
Why is that important?
To prevent firms from using layers of entities, maybe registered in different jurisdictions, to obscure their true activity or potentially circumvent rules like the restrictions on intraday trading for FPIs that Jane Street's Indian arm allegedly helped navigate. You need to know who is ultimately pulling the strings and benefiting.
Right. Follow the money, follow the control. Anything else?
And, crucially, there's a growing demand for faster action on unusual profits.
Faster action.
Yeah, basically developing mechanisms or red flag system for regulators to intervene much more quickly when a firm shows sudden, unexplained, and massive gains that seem statistically improbable or out of line with market conditions.
So don't wait months for an investigation.
Ideally, no. The idea is to have triggers that allow regulators to potentially freeze suspicious accounts or halt specific trading activity much sooner to minimize the potential damage to the market and other investors while a deeper investigation happens. The speed of response is just absolutely critical in these high-frequency trading environments where fortunes can allegedly be made or lost in seconds through manipulation.
Yeah, time is definitely of the essence.
Right.
Now, we saw the immediate ripple effects of Sebi's action on related companies. Shares of Nuvama Wealth Management, who was identified as Jane Street's local trading partner, their stock plunged 10.6% right after the news broke. And other related entities like BSE, the stock exchange itself, and CDSL, a major depository, also saw significant dips in their share prices.
Yeah.
People got nervous.
Understandably so. It raises questions about counterparty risk, reputational risk, and potential loss of business for firms associated with Jane Street.
But what about the broader market? Specifically, market volumes. Has Jane Street's ban actually had a noticeable impact on overall trading activity in India? They were a huge player, right?
Yes, they were. And the impact on volumes is definitely being felt and discussed quite widely across the market right now.
What are people saying?
Well, Siddharth Bumre, he's a head of institutional research at a brokerage. He noted that Jane Street was undeniably one of the largest traders contributing to Indian markets, a major liquidity provider.
Right.
And he explained that when such big players are banned, especially under a cloud of alleged wrongdoing like this, others become cautious and reduce activity, leading to lower volumes.
The killing effect.
Exactly.
Yeah.
It's a natural, albeit potentially temporary reaction. Other large prop firms might reassess their own strategies, worry about increased regulatory scrutiny, maybe tighten their risk parameters. It can lead to a general pullback in risk-taking and liquidity provision.
And Nitin Kamath, the founder of Zerodha, a huge retail brokerage in India, he also weighed in, right?
Yes, he highlighted the sheer scale of their involvement. He stated that prop trading firms like Jane Street account for almost 50% of options trading volumes in India.
Half the market? That's enormous.
It is. Almost half the options market driven by these proprietary trading firms. And he warned that if these prop firms pull back significantly, either because of this case or potential new regulations, it could also impact retail activity, which makes up about 35% of options trading.
How would it impact retail?
Because these large prop firms provide a lot of the liquidity. They are often the counterparties to retail trades. If they pull back, bid-ask spreads might widen, making it more expensive for retail traders to get in and out of positions. It could make the market less efficient, less liquid for everyone. So yes, the potential for a significant drop in overall market liquidity and participation is very real, and it's a concern for market participants and regulators alike.
50% from prop firms. That's a huge chunk of the market relying on these players. Does this mean India's derivatives market, the world's largest, remember, is maybe too dependent on these large proprietary trading firms? Does it make the market vulnerable if one or two big ones get taken out or pull back?
That's a really important question, and there are different perspectives on it. While the immediate impact on volumes can certainly be felt, and maybe even painful in the short term. Dinesh Thakkar, he's the chairman and MD of Angel One, another major brokerage. He offers a perhaps more optimistic long-term view.
Okay, what's his take?
He believes India's market opportunity is fundamentally, quote, structural, not cyclical, and certainly not dependent on any one firm.
Structural, not cyclical, meaning?
Meaning the growth is driven by deep, long-term factors, demographics, economic growth, increasing financialization, not just short-term trends or the presence of a few big players. His view is that the Indian market is so attractive, the opportunity is so large, that when one major player exits, for whatever reason, others are often quick to step in to fill the void.
So nature abhors a vacuum, essentially.
Kind of. The argument is that capital is global and seeks opportunity. If Jane Street leaves a gap, other prop firms, maybe domestic ones or other international players, will see an opportunity to gain market share and will step up their activity. This suggests a fundamental resilience and attractiveness of the Indian market that transcends the presence or absence of a single large firm.
It's a more reassuring perspective.
It is. While the immediate shock and caution are undeniable, the long-term outlook, according to this view, suggests the market has enough depth and enough other eager participants to eventually recover and continue its growth trajectory. However, it certainly underscores the enduring need for robust oversight to ensure that any new entrants and the existing players operate ethically and within the bounds of the law. Resilience doesn't mean you don't need rules.
Absolutely. Oversight is key. Now, if we connect this to the bigger picture again, the fallout from this case might not just be limited to Sebi's domain, the securities regulation. There are potentially significant tax implications too, aren't there? Especially given that a lot of those alleged profits were reportedly booked overseas and repatriated.
Indeed. This adds another really complex layer to the whole situation. Tax authorities in India are highly likely to be scrutinizing Jane Street's structure and, more importantly, their profit allocation under India's General Anti-Avoidance Rules, GARS.
GAR, what is that briefly?
GAAR is a relatively powerful framework in India's tax law. It's designed specifically to counter aggressive tax planning arrangements, particularly those that lack genuine commercial substance and appear to be primarily intended for tax avoidance rather than reflecting real economic activity.
Okay, so it looks beyond the legal form to the actual substance.
Exactly. Now, as Sebi noted, many of Jane Street's massive profits were reportedly booked in their Singapore FPI entities.
Singapore. Why Singapore?
Likely to potentially leverage the favorable tax treaty between India and Singapore, which, under certain conditions, can offer exemptions from Indian capital gains tax for investments routed through Singapore. It's a common structure used by FPIs.
Okay. But what's the potential GAAR issue here?
The critical point is Sebi's allegation about the role of the Indian entity, JSI Investments. Sebi claims the Indian entity executed those intraday trades, the ones that systematically lost money, remember,
Right.
which FPIs themselves are generally not permitted to do. This raises significant questions for the tax authorities. Was the substance of the profit-generating activity actually happening in India, orchestrated from India, or heavily reliant on the Indian entity's actions, even if the profits were booked in Singapore?
So where was the real economic activity happening?
Precisely. If the tax authorities conclude that the Singapore entity was just a conduit and the real economic engine in the alleged manipulation were driven from or through India, possibly using the Indian entity to circumvent rules, then GAIR could potentially be invoked.
And what would that mean?
It could mean that the tax authorities might seek to disregard the treaty benefits, reallocate those profits booked in Singapore back to India, and subject them to Indian corporate income tax.
Which would be a huge tax bill on top of Sebi's disgorgement order.
Potentially, yes. It adds a whole new dimension of potential financial recovery for the Indian government, completely separate from Sebi's securities law actions. It's a significant financial risk for Jane Street beyond the regulatory penalties.
Okay, so tax is another major angle. But even sticking with Sebi's action, that order to seize nearly 5,000 crore rupees, legal experts are apparently pointing out the complexities of actually enforcing that. It's one thing for Sebi to issue an order within India. It's quite another to successfully collect that kind of money from a massive, sophisticated global financial firm. What are the legal and practical hurdles involved here?
That's a hugely significant challenge, you're right, especially given the global nature of Jane Street's operations and the incredibly dynamic nature of high-frequency trading itself.
Also,
Well, Ravi Hegde, a legal expert quoted in some reports, pointed out very astutely that, quote, nobody knows whether that money is still with them or whether it has been deployed in other trades.
the money might not even be sitting there waiting to be seized.
Exactly. Funds and high-frequency trading firms are often in constant motion. They're moving across borders, across different asset classes, through various bank accounts, being used as collateral, being reinvested, all with incredible speed. This makes them notoriously difficult to trace comprehensively and then effectively freeze or seize.
It's like trying to grab smoke.
It can be. It's a real hydra-headed challenge for regulators worldwide when dealing with global HFT firms. Sebi might have frozen the known Indian accounts, but the bulk of the alleged profits might already be offshore, potentially moving through multiple jurisdictions.
So Sebi might have to pursue them internationally.
Very likely. They might have to initiate complex international legal proceedings, relying on mutual legal assistance treaties or other cross-border enforcement mechanisms to try and enforce the Indian order in places like Singapore, the US, or the UK, where Jane Street has major operations and assets.
That sounds like a long and difficult process.
It often is. Each country has its own laws regarding asset seizure, the enforcement of foreign judgments, and protections for corporate entities. It adds layers and layers of legal complexity and potential delay. It becomes a high-stakes game of international legal chess, where every move has to be carefully considered to prevent the funds from simply vanishing into another part of their global balance sheet or getting tied up in endless litigation.
Okay, and Hegde, the legal expert, he also made another strong point about the trades themselves, right? Something about economic sense.
Yes, he made a powerful assertion. He argued that these alleged trades, particularly the patch 2 sequence where they bought high and sold low in the cash market, they made no economic sense on the surface.
Meaning they weren't rational trades in themselves.
Exactly. What he means is that these likely weren't typical legitimate arbitrage strategies, which usually involve buying low and selling high simultaneously, or normal market-making activities that exploit natural small price differences. Losing money deliberately on large stock trades isn't usually a goal.
So why do it?
Hegde argued, and this aligns with Sebi's view, that they were likely executed solely to influence the index movements, to create that artificial rise and then the crash, specifically to make their real bet the massive options positions pay off. And importantly, he suggested, to mislead common investors who saw the index moving and assumed it was based on real market forces.
So the stock losses were just a tool for the bigger options play and market deception.
That's the argument.
Yeah.
And Hegde went further, stating, per se, it is a fraud.
Fraud, that's a strong word.
It's a very strong legal assertion. It suggests a clear, demonstrable intent to deceive and manipulate for gain. It elevates the case beyond just a regulatory violation of market rules to something potentially more serious, bordering on or constituting a criminal offense, depending on how the evidence stacks up and how Indian law interprets it.
Okay.
Yeah.
This whole case, the scale of it, the alleged methods, the regulatory response, it becomes even more critical, even more globally significant when we remember the context. India hosts the world's largest equity derivatives market,
By trading volume, yes, it's massive.
accounting for an incredible 60% of global trading volume in equity derivatives. So what happens here doesn't just stay in India. This case truly is a flashpoint for deeper market reform, isn't it?
Mm.
A real test of the market's foundational integrity on a global stage.
Absolutely. It really throws a spotlight on how sophisticated, globally connected entities can allegedly distort fundamental market mechanisms. Mechanisms like arbitrage, which are absolutely essential for market efficiency, price discovery, and overall fairness.
Explain arbitrage again briefly and how it was allegedly distorted here.
Sure. In a healthy, well-functioning market, the price of, say, an index future contract, like the Bank Nifty future, tends to stay very closely aligned with the price of the underlying assets, the actual Bank Nifty index value derived from its constituent stocks.
They should move together.
Very closely, yes, because of arbitrage. If the future gets too cheap relative to the underlying index, savvy traders will instantly buy the cheap future and sell the underlying stocks, or vice versa, locking in a small, risk-free profit. This very act, done by many traders constantly, helps push the prices back into alignment. It's a natural, self-correcting mechanism.
Okay, it keeps prices honest, essentially.
Exactly. It ensures the price reflects the real underlying value. Now let's use that water bottle analogy again. Normally, if water costs $1 at store A and $2 at store B right next door, arbitrageurs, people looking for risk-free profit, would quickly buy all the $1 water at store A and sell it for just under $2 at store B. This buying pressure raises the price at A, selling pressure lowers it at B, and soon the prices equalize, maybe at $1.50. That's efficient.
Right. Arbitrage closed the gap.
Yes, but Jane Street's alleged actions, according to Sebi and experts like Hegde, were like purposefully creating a fake traffic jam right in front of store A, making it impossible for most normal arbitrageurs to get there easily to buy the cheap water.
Right.
This artificial barrier makes store B's $2 water seem like the only available option, or artificially more expensive than it should be relative to the true values still theoretically at store A. While doing this, Jane Street was simultaneously placing a huge bet, their options position, that this engineered price difference between the future and the underlying, or between different option prices, would increase.
So they weren't closing the gap, they were allegedly widening it for profit.
Precisely. They then allegedly profited handsomely from that fabricated, unnatural gap, effectively disrupting the market's natural balancing act. This isn't just about making quick profits. It's about fundamentally undermining the core mechanisms that ensure price integrity and a level playing field for everyone else who relies on those prices being fair and efficient.
That's a really clear way to put it. So the regulators' next steps here, the reforms they implement, the outcome of the enforcement, it's not just about this one firm, Jane Street. It's about setting a crucial precedent, isn't it? A precedent for the credibility of India's entire surveillance and regulatory system in this new era of high-speed, cross-border, algorithm-driven trading.
Exactly. This case could truly shape the future perception and reality of India's financial landscape. The eyes of the global financial world, other trading firms, institutional investors, other regulators are firmly on Sebi and how effectively it handles this from here on out.
What will they be watching for?
They'll be watching the appeals process, the success rate of the disgorgement efforts, and most importantly, what concrete regulatory and technological reforms are implemented as a direct result of the vulnerabilities exposed by this case. Those actions will signal how well India can protect its market integrity, how serious it is about deterring manipulation, how attractive it remains for responsible foreign capital, and ultimately, whether it can ensure a truly level playing field for all participants, from the smallest retail investor nervously watching their screen to the largest global trading firm operating from thousands of miles away. It's a pivotal moment.
It really is. Okay, we've taken a really deep dive today into this remarkable and, yes, quite concerning story of Jane Street's alleged market manipulation in India.
A lot to unpack there.
Definitely. We've seen how a global powerhouse allegedly leveraged incredibly sophisticated strategies, the dual-phase approach, marking the close, the FBI local entity structure, to potentially generate massive profits.
Profits measured in the thousands of crores.
We've seen how regulators like Sebi, prompted by warnings in their own investigation, stepped in with pretty stringent actions: the ban, the freeze, the disgorgement order.
A strong response.
And we've explored the far-reaching implications for market integrity, for retail investor trust, for the need for regulatory reform, potential tax consequences, and even the challenges of enforcement.
Yeah.
It's a stark reminder, I think, that even in highly regulated and increasingly sophisticated markets like India's, powerful players will always test the boundaries, sometimes allegedly crossing them significantly.
Absolutely. And this case really underscores a crucial point. While India's financial markets are undeniably robust, growing rapidly and attracting huge amounts of global capital and innovation, constant vigilance and adaptive regulation are absolutely paramount. You can't just set the rules and walk away.
The game keeps evolving.
Exactly. Knowledge, as they say, is power, but it's most valuable when it's understood and applied. And hopefully this deep dive helps us, and you, the listener, see not just what allegedly happened, but why it matters so much for the entire ecosystem of investors, institutions, and the future health of the market. The alleged actions of the single firm have really ignited a critical and necessary conversation about the future of fair play in high-stakes global finance.
They certainly have. And as India's financial markets continue their rapid ascent, attracting ever more complex trading strategies and participants from around the globe, this whole situation raises a really important, maybe provocative final thought for you, our listener. In this environment, how can you as an individual investor truly arm yourself? Not just with market data, but with the critical thinking skills needed to understand the complex dynamics potentially at play behind the price movements you see on your screen. How do you navigate an environment where the playing field might not always be as level as it appears?
That's the million-dollar question, isn't it?
It is. And alongside that, what more do regulators, not just in India, but globally, need to do? What tools, what rules, what international cooperation is needed to ensure a truly transparent and genuinely level playing field for everyone, from the smallest retail trader just trying to build some wealth for their family to the largest, most powerful global trading firm? It's certainly something profound to ponder as you look at the markets tomorrow.